The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. Today, we're joined by Michael Nadeau, a crypto data and research analyst and author of the DeFi report. In this episode with Michael, we explore the main differences between traditional assets and crypto assets, especially from the perspective of more traditional and institutional investors. We mainly focus on layer 1 blockchains and how they can be valued. We cover topics including the roles of key metrics in analyzing both traditional and then crypto assets. We speak about market consensus and the roles of buy and sell side analysts in these markets. We cover the similarities and differences between blockchains and Web2 businesses and how comparisons can be drawn from specific key metrics. Mike also walks us through several valuation frameworks and how these can be applied to blockchains. And we wrap things up with thoughts on how he sees valuation frameworks developing now that institutions are slowly entering the space. Hey, Michael, welcome to the Fundamentals podcast. It is great to have you on.
Great to be here, Gary.
I've been looking forward to this one. It's going to be a bit of a different type of session with the goal of providing some context to how institutional investors view the crypto asset space. And when we booked this session, we didn't have all of the latest announcements in the market, but it's become an even more timely topic now with BlackRock applying for the Bitcoin spot ETF. And then we also have the large players, Fidelity, Citadel, and Charles Schwab kind of entering the space via an exchange. So this is going to be really cool to kind of explore how these players might be internally wondering how to kind of value these assets and just break down the space in general. But before we get into the details behind crypto versus TradFi and how that can be approached, it would be great if you could give a quick introduction. So kind of walk through your background and then, quite frankly, how you're the right guy to speak about this stuff with us today.
Absolutely. Yeah, happy to. So background before crypto was primarily in traditional finance. I spent about 10 years in the commercial real estate industry. Actually started my career working for a family office for about 2 years, then moved into commercial real estate. Did about 10 years, 6 years at a publicly traded REIT called Boston Properties. And then I moved over to MIT and worked on their direct real estate portfolio. And it was really my time at MIT that kind of like opened me up to what was happening with crypto. So just being exposed to a lot of interesting things at MIT at the time, started learning more. They have a digital currency initiative. We're supporting a lot of development throughout the ecosystem. So my kind of intellectual curiosity took me down the crypto rabbit hole, I guess. And it was really once data providers started to come out and you could actually see what was happening on chain is when I really started to go much deeper into what was happening with crypto, because you could get to like the fundamental truth of what was happening on these crypto networks. So for the last 3 years or so, been working directly in the industry, worked for a startup called Invenium, which is focused on data informing tokenized real world assets. So I was director of ecosystem strategy at Invenium for a little while. I've been writing a newsletter called the DeFi report that goes into really using analysis of what's happening on chain to inform like fundamental business model analysis, valuation frameworks for crypto assets. And I currently do some consulting with large asset managers, VCs, hedge funds, family offices that are trying to wrap their heads around crypto, how to value crypto assets, what's happening on chain, really kind of get to the nitty gritty of how to analyze these networks. So excited to talk about all this with you today.
Awesome. Thank you for that great overview. And I got to give you props for especially the DeFi report and the content that you very consistently put out on LinkedIn. You're able to take very complex concepts and translate them into a way that it's quite easily digestible by a Wall Street audience. So definitely the right guy to be speaking about these. Now, I think a great place to start here would be just high-level framing of traditional assets versus crypto assets. An institutional investor lives in a world where they live and breathe traditional assets. You have stocks, bonds, real estate, whatever it might be. And now that crypto's come into the picture, they're kind of trying to find similarities between the two. But you take a crypto network such as Ethereum, it's not too easy to fit into any model that they are used to. If we take a traditional asset like a stock and a crypto network like Ethereum, could you really spell it out what the main differences between these two assets are?
So yeah, there's a lot of differences. There's some similarities, and like when I talk to people, I try to meet investors like halfway, right? And there are some similarities to like traditional capital assets, like you mentioned. They have revenues. They have, some of them have more like commodity-like features. Some of them have more store of value like features. But there are many differences, and this is one of the challenges that regulators, like in the U.S., like have to kind of go through right now to determine, are these securities, are they commodities? They're multifunction, right? So I think the first thing to really hone in on is like when you take an asset like Ether, which is like the native asset of the Ethereum blockchain, that asset can be used to like pay for services within the Ethereum network, pay for gas fees, pay for block space. You can also potentially use that asset to provide services to the network by staking your Ether. You could use the token not within the Ethereum ecosystem, but if it was a different ecosystem, potentially to vote on governance of that ecosystem. So I think the first thing is like multifunction, whereas you're not really using your Apple stock for anything other than investing in Apple and hopefully getting a return on that investment. So multifunction is kind of the first one. Crypto assets, and just so to be clear for anybody watching or listening, we're referring specifically to blockchain native assets. So things like Ethereum, that the asset that powers like an L1, or the asset within a protocol that's used for governance, separate from digital securities, just tokenizing real estate. So we're focusing on blockchain native just for this conversation. The other thing here is those assets don't convey legal ownership like a traditional stock would. So you're not going to have like legal rights to interest or dividend payments, to liquidation preferences. So that's another like big difference there. The data structure of public blockchains makes these fundamentally different as well, in terms of these are digital bearer instruments. So that impacts how the asset can be custodied. A user can self-custody these assets. We can transfer them in a peer-to-peer manner. The assets themselves trade 24/7, 365 globally in liquid markets, which is very different from traditional financial markets that are trading, Monday through Friday for, 7.5 hours. If you add all of that up, crypto assets are trading 5 times the number of hours as traditional markets. And when you think of markets as like information processing machines, that means like crypto is just constantly processing information. I think this leads into some of the volatility of crypto networks as well, just because throughout the globe, somebody's processing information and acting on that information. The other thing, just related to the data structure itself, is you can bundle services on public blockchains that really cannot be bundled within traditional assets and the infrastructure underneath them. And what I mean by this is like transfer agents, for example, can potentially be like a smart contract where you can automate markets and you can automate business logic through a smart contract, and you don't need that like third-party transfer agent. Same idea with custody, because you can self-custody these digital bearer instruments, some of these services, and then the network itself is like this constant automatic audit, automatic like accounting ledger. So you can kind of bundle a lot of these services, reduce costs, create efficiencies on public blockchains. And then the one that's like really important, that's kind of like what we're going to get into in this discussion today, is all of the data is on chain, right? So public blockchains are like these permissionless, fully transparent, open data networks where anybody can access the data that's on these networks. Places like Token Terminal do a great job of visualizing that data, making it really easy to analyze it and do research. But all the data is publicly available for anybody to access. Those are some of the big ones. Bit of a ramble there, but those are some of the like kind of big differences just between crypto assets and like a traditional stock, real estate bond.
Not a ramble at all. That was very clear given how complex these multifunctional tokens can be. But definitely, I think like at a very high level, you'd say a stock is just a much more straightforward asset that does one thing, whereas a crypto token has a lot more, well, it's more like programmable equity. That's a term that I like to use, and you can program different use cases for it, and the sky's the limit basically. But given that kind of multi-functionality, when we think of an investor who looks at a stock, you have very specific key metrics that they would usually first look at when you want to analyze how a company is valued in relation to its business operations or market in general. Now, what would you say the role of like main key metrics is in analyzing assets, and like the differences especially between traditional and then crypto assets, if you're able to go through that via some examples?
Yeah, so I think it's a great question. And it's like one of the challenges with crypto in general today is we don't have like this fully formed consensus on how to value value different assets, whereas you do have this in most traditional frameworks. So, the market is going to look at different key data points, different metrics, different ratios for different assets, but there is a general consensus and agreed upon formula and a way to do that. So you have like things like price to earnings, earnings per share, debt to equity, revenue multiples, all of these different metrics that the market's using. We have like for publicly traded companies, there's a framework that needs to happen every quarter with an audit from a third party. The financial statements need to be signed. All of that data is then made public to investors. And then the market essentially, processes all of this information and comes to like a consensus on what the proper value is. And that informs market prices. And this is like something that's, taken place over many decades. And we have like this really well-formed, like basically social construct around all of this. Crypto networks are these new assets. We just talked about all these differences. And that doesn't even get into sort of the abstract nature of like really getting into the details of like the business models and like how something like Ethereum produces revenue. But we don't have all of this infrastructure currently. Token Terminal is bringing these metrics and these fundamentals to the market. And it just takes time for market participants to start to correlate different metrics to market prices before we get like this agreed upon similar like built out structure to value these assets. Networks leads to market prices. You get less information asymmetry, probably less volatility as that starts to happen. But I think that's like some of the main differences and just kind of like the market structures today.
Yeah, definitely. The lack of structure is very inherent. Like I can say firsthand that when we're thinking about new metrics to introduce at Token Terminal, the primary goal really is to showcase new data points in a way that's as comparable as possible between different projects. So, bringing a level of standardization to metrics and methodologies so that investors can use these metrics for the relative analysis between projects, which is a great starting point and can be later expanded on.
Yeah, and it's a great point. And like, I think this is something, it's always nice to like look back at other periods of innovation. And like, this was something that was happening also during like the late 90s when you had all these like new internet companies that were popping up that were kind of pre-revenue, but they could show like, hey, we have all these like eyeballs, right? That are just like, we have these views on our webpage, like this has to be worth something. Almost like today with crypto, it's like, look at all this total value locked over here within this platform. You can start to see like some of the similarities to past innovation cycles. So it's not the first time we've kind of gone through this.
Definitely not. And for example, the core developer metric that we introduced some time back has been subject to critique from some parties. But that being said, the methodology is very clear and we've confirmed the values to align with the actual number of core developers that many projects have. Also on discussions on this pod, actually. So the metric is definitely a useful proxy for relative analysis between projects right now, even though it might need fine tuning in the future. And of course, no metric should ever be used in isolation. So that's important to remember too, especially in this innovation phase where, some new metrics that are introduced in the market can be quite experimental. But as you spoke about market consensus briefly and analysts' roles. I feel that in the traditional market, one really integral part of why the framework works so well is because there is such a large amount of analysts on both on the buy and sell side, taking in the information, processing it, and putting out estimates. And then, of course, it is easier for someone from the outside to look at these estimates and see what the market consensus is and whether they agree with it and then base investment decisions on that. It would be great if you could briefly walk us through kind of the typical roles and perspectives of both buy and sell side analysts, maybe starting with the tradfi world and kind of how they've developed to where they are now.
Absolutely. And yeah, this plays into kind of how the market like achieves consensus and like, I guess some of like the herd behavior of the market related to this. But yeah, you have, buy side analysts that are primarily working internally for large financial institutions, doing research on various sectors, on various individual companies, and then sharing that research, primarily internally for their own investment books. That's kind of like the buy side of this. And then you have probably even a much larger like sell side analysts out there where these are like research services. These are people that work at investment banks that are doing similar research, on various markets, sectors, businesses directly, and then putting out that research into the market. And then investors are looking at that data, comparing it to their own research, trying to figure out if they know something that the market doesn't know, and then acting on that. So I think in addition to everything we talked about in terms of all the metrics and all the ratios and like the structure around audited financial statements, all of that, in addition, you have these analysts out there that are also seen as like somewhat of like experts for the industry, that the market then also uses that information to like formulate market prices. So this is coming, like you see this in crypto right now. This is like on Twitter, right? Someone shares like a chart of like token terminal, or I do a lot of this on LinkedIn where I share data, oftentimes with token terminals data, and try to like analyze the data and provide a view that the market can then start to incorporate into various analysis. So
would you say that kind of the current state of this buy side, sell side analyst dynamic in crypto right now is just the open dialogue happening on Twitter, LinkedIn, and these platforms?
I think so. And what's interesting about it too is because it's all on chain. We mentioned before, like everything's on chain. And so not only do you have anybody can be like an analyst and put their thoughts on Twitter and show like transparent on-chain data, but you also have people that actually track things right on like Etherscan, and they're actually following the wallet's activity of really large whales and players out there. And so you can actually see like the movement of like assets and things like that. People then report this on Twitter. Twitter is like, now you have this information processing machine. So it's fascinating to see the progression of markets and kind of what crypto is doing to this, because if you think of information as a information processing machine, when you have social media and the combination of like on-chain data, which is almost like a continuous financial statement, it's pretty fascinating to see kind of where that's all heading.
Yeah, it 100% is. And I mean, from an investor's perspective, I'd say there's a lot more noise to filter out too. I also feel a bit more knowledge is needed to get a basic level of trustworthy analysis, as crypto Twitter is full of these threaders fighting for engagement with pretty whack analysis sometimes. Whereas in traditional markets, the bulk of analysts represent quite reputable corporations, be they investment banks or something else. But that combined with different licenses, certifications, educations, or whatever, which are of course all just social constructs, they still do increase the amount of trust that people have towards the analysis that is put in front of them. So, it'll be interesting to see how this dynamic develops in crypto and whether the space will maintain its more indie type of analyst culture alongside institutions entering the market. Now, we spoke a bit about what the analysts' roles are when digging into different assets, but if you were to break down the main differences between a traditional due diligence process and what we have in crypto today, how would you sum it up?
We talked a little bit about this, like just getting into like the process too. Like if I'm going to analyze Apple stock, for example, like you're going to deeply understand what are their different product lines. What are the growth metrics on all of these various product lines? How good are they at managing their expenses? What are their competitors doing? So you're going to get like this full picture of like what's happening in the market that they operate, as well as their business, and then analyze their financial statements as part of that. And I think with crypto, it's the process of like deeply understanding the economics of what's going on, like it's the same. Like with Ethereum, it's a different business model. It's a network, right? So there are many other factors to be thinking about with something like a network, because you have all of these other businesses that are building on top of the infrastructure that drive value back to Ethereum through user transaction fees, which are paid out to validators. And so like the economic structure is extremely different, but at the end of the day, you're trying to analyze like how does this thing actually create economic value. So that doesn't change. It's just, and we're going to get into this later, how exactly does the business model work? And then what are the key drivers for economic value creation there? And that's really what Token Terminal is bringing to the market. Which metrics should we be looking at on Ethereum that drive the core like economic value driver that the market is then going to use to price that network? So fundamentally, the process is the same. In practice, it's different metrics, different business models.
As we've been speaking about Ethereum, I'd say let's focus on that for a bit here and dive even deeper into maybe the specifics. I think it would be good to probably lay out Ethereum's business model and how it can be seen, because that's also something that maybe divides a bit of opinions on what Ethereum is. Is it a business? Is it an economy? Is it just a network? Is it something else? From our perspective, every single crypto project can basically be thought of as a platform business that connects the demand and the supply side. In Ethereum's case, what's happening is that network is connecting users to validators. And the business model there is users will pay a transaction fee for the right to settle transactions onto that network, and validators who take care of that settlement then get a portion of those transaction fees paid, and the network itself also incentivizes these validators to keep doing that good work. And how Ethereum as a network captures value from that is that a portion of the fee paid by the user is burned, which puts deflationary pressure on the network token itself, and thus could argue that it accrues value to token holders by being similar to a share buyback type of mechanism. So that's kind of the high level. And if we think of this business model, what would you say like the relative comparisons are that an investor could draw to more traditional assets? And I'll let you freely just pick any specific metrics that you kind of want to tag onto and speak about.
That was a great description of like kind of the business model and how it works. If I wanted like a traditional investor to like think about Ethereum in terms of a large traditional business, I would say like it's probably comparable to like Amazon or Apple or something. Like these networks that, like Apple, for example, when you go on your phone and you have an app store, all of those apps are paying back to Apple to have access to that marketplace. And you could think of that in terms of like Ethereum as like this base infrastructure and settlement layer where and the functionality of the smart contracts, you have all of these other businesses that essentially build their own smart contracts using Ethereum. So Ethereum's kind of like the marketplace. And as those businesses that are built on top bring in users, there is a fraction of a fee that gets paid to Ethereum validators at the base layer. Just like, any app developer has to pay, the users that come through there, whatever the business model is, sometimes it's advertising, but they're paying back to Apple. So same concept. There's many differences when you look at the economic structure of having a distributed set of security and validators, and all of the economics are pushed out to service providers around the marketplace versus that value getting captured more towards a centralized entity. But I think that's probably like the best way to like kind of just think through an analogy of a traditional company.
That was great. And I think the App Store analogy is actually one of the best ones that I have heard of when it comes to comparing traditional companies to blockchains. And it applies to all blockchain networks pretty much, because you're taking a tax or a cut from all the revenue that the applications built on top of your network generate. So that's like a really easy to understand one. I'm glad you shared it. Then if we move on to a bit more of a granular level, so individual metrics, I feel that a lot of them are quite self-explanatory in terms of comparisons to traditional businesses. For example, the different forms of total value locked in DeFi. So like net deposits and assets under management are terms that people are familiar with traditional financial institutions as well. And then there's revenue, of course, which, although more diverse in crypto in terms of how it's generated and distributed via sometimes direct cash flow, sometimes token burns. You also have like real-time revenue sharing or dividend distributions built in, etc. But I think one that might be a bit confusing from the outside is token incentives, and just the sheer amount of incentivization of activity that happens in crypto. I wanted to ask that in crypto, you incentivize users, usually with your governance token or the network's native token, to perform some sort of activity, be it validate a network or just become a user to kind of build that kind of mass user base that you can then start building more sustainable activity on top of. Would you agree with the comparison that that's actually just like exactly the similar model that a venture-backed businesses like Uber did, using venture capital money to subsidize rides and make them very cheap for users to use that? Or is there also something else there?
I think that's the right way to think of it. And that's how I think of it. It's a cheaper way to basically pay for like network growth in the early days. And like, I think the Uber example is a good one, because you can, in almost all crypto projects or networks are two-sided markets, and these are really difficult to bootstrap. And so like Uber, for example, they needed drivers and they needed riders. So they had to incentivize one side of that with like really low fares. And they had to make sure they had enough drivers, and they had to lose a lot of money in the early days to kind of get that network effect going to the point where they could raise the prices. And so crypto networks are doing the same thing. They're using the token to incentivize like the supply side of the network. So for Uber, they needed to incentivize drivers. Something like Ethereum or Bitcoin needs to incentivize the security that's going to run the network, right? So they need validators, or for Bitcoin, it's Bitcoin miners. And so the blockchain itself pays out some, token incentive, which is really like the equity of the network to incentivize these people to provide services to essentially bootstrap the network. So to me, it's like, it's just a better capital formation tool, an incentive mechanism to create these like much stickier sort of multi-sided networks for these new business models. And that's kind of how I think of tokens. But yes, I think it's very important to be looking at the relationship to token incentives and to like what's actually happening with revenues, because a lot of projects will just dish out, whether it's liquidity mining or there's different incentive programs that a project will do to get users. And that can be a bit of a head fake. If you're analyzing these things, you might see like a lot of revenue jump up. But then if you look at token incentives, okay, it's not, maybe they don't actually have product market fit and the users just came because there was some new token incentive, some new airdrop, something like that. So a lot of nuance to it, but to me it's just like a superior capital formation tool.
One thing that comes up a lot when I speak with more traditional investors is like how much these crypto projects are losing money when you look at something like the earnings metric on the token terminal, which calculates revenue minus token incentives. But then again, if you look at venture-backed businesses, they just weren't public when they were doing this. So there wasn't like the data in real time. So it's nothing new that's really happening. And I would argue that the only difference really is that in Uber's case, you raise venture funding, you dilute existing shareholders, which are a very small group of people. Whereas in crypto, when you give out token incentives, one argument is that, yeah, you dilute away value. But then again, you're distributing ownership of that network or that business, which is actually a pretty nice approach. And if done right in the long term, just ends up in a much more decentralized model. So lots of nuances, but I think the multifunctionality of tokens there also brings its own difference. The incentivization isn't as straightforward as it has been in like the traditional case.
Yeah, I couldn't agree more. And it's fascinating to see how, there are ways to do this properly. And like when you see a really good token launch after product market fit has been achieved and, they already have a bunch of users, they will reward those users with an airdrop. And like you said, all of a sudden now all of your early users have equity in the project, pseudo equity in the project. And now those people become like evangelists for the project. They're on Twitter, they're promoting. So it's almost like free marketing, organic marketing. And like you get this like really interesting network effect by being more inclusive with your equity. So it's fascinating. And this is something that's almost like there are like legal challenges for companies just to do this in traditional finance. So it's really interesting to see some of these new frameworks that crypto is putting forth.
Yeah, and it definitely is. And just like kind of final note on this, what I want to say is that Ethereum from 2016 up until I think it was around October 2022, and pull up a chart from Token Terminal here, the earnings were like very highly negative. But then once that flip happens, even in a bear market right now, it's very profitable activity from the perspective of there's more deflationary pressure on the token. So it takes a while to build a sustainable network. And then I want to move on to valuation methodologies. And I think these are one thing that impressive in your LinkedIn posts is how thoroughly you're able to kind of apply different types of valuation models and methodologies to these blockchain networks, because I think that's very much needed to get a full picture. Because as we've already talked about during this session, a blockchain network is not just one-to-one comparable with anything in the traditional world. You really need to look at it from many different perspectives. So I have a few different valuation methodology and frameworks kind of listed out here. And what I'm going to do is go through them one by one and ask you to kind of explain what each one is and then how you would apply that to crypto. So to start off, I'd love to hear what the Robert Greer framework is and how that applies to something like Ethereum.
Absolutely. Yeah. So this is like a framework for the super asset classes that Robert Greer put forth. And I think it's interesting and it's very applicable to how you would think through like a layer one token, for example. So the framework here is like there's three major asset classes. So you have capital assets, you have consumable, transformable assets, and you have store value assets. And so when you start to think of like Ethereum and you go through the business model and you do all your analysis and you sort of step back and you look at the Robert Greer framework, you could look at it and say like, wait a minute, like this thing seems to have all three of those built into it. So like the capital asset piece of it, this would be the sort of element that produces cash flows. So, capital assets are stock, real estate, bonds, things like that. You could look, and do your analysis and you can look at pull up Token Terminal and get your 365-day user transaction fees on the network, and you can project that forward, right? And come up with some assumptions on what you think the growth metrics will be for that, and then discount it and run a discount cash flow analysis. And that's an analysis that you would see more in like the traditional finance world, and you can apply that to Ethereum. That's the capital asset piece of it. Ethereum is also fits into number 2, which is the consumable transformable asset. And this applies to things like commodities like oil or corn, because ETH, the asset, is consumable, like you mentioned earlier. When a user transacts on the network, part of their transaction fee is actually burned, right? And so just like if you buy some oil and you go on a long road trip, put gas in the car, you're burning that. The interesting thing with Ethereum is that burned element of that actually accrues to passive holders of the asset, because you reduce the circulating supply. Anytime you reduce the circulating supply of something that has a market price to it, like the price has to go up. And Warren Buffett loves stock buybacks. This functions as like a stock buyback essentially. So that's your consumable transformable piece of it. And then the third one is like a little bit harder to project out, but it's like the store of value sort of money asset nature of something like Ethereum, which is used as a unit of account, not just within like the Ethereum network to pay for services, but actually like NFT markets as well. Like you use Ethereum to buy an NFT in these marketplaces. So there's like a moneyness to Ethereum, but these are the type of assets that they don't produce cash flows, or they're not consumable. So it would be like art, fiat currency, things like that. And the market typically applies some sort of monetary premium for store of value assets. This is the piece of Ethereum that is much harder to project out. You could run the cash flow analysis and say, okay, this is what I think it should be worth. But then you have this like store of value monetary premium when you compare it to other layer 1 blockchains and forecast out its growth potential. That's the piece of it that like can put Ethereum's valuation much higher, I think, than the market like currently is projecting. So that's one piece. We can go much deeper into this with some of the other valuation frameworks, but that's just like the high level thinking around like how to analyze this asset.
I love that framework, I gotta say, and also have to tag on to what you said about Warren Buffett there. Warren Buffett likes stock buybacks. I'm 100% certain that if he understood the fundamentals of crypto and took time to study it, he would also love crypto. But he'll get there, maybe. Now, second model I want to speak about is anyone who's ever done anything in finance would be familiar with DCF models, so discounted cash flow analysis. What do you see as that model's role in crypto, and how can it be applied today, especially because we are so early and cash flows are pretty hard to kind of project?
I like having it part of the analysis, especially when you're dealing with or talking with a traditional investor that's used to discounting cash flows. I think it's useful, especially for something like Ethereum that has billions of dollars of annual fees running through it. And it also, like, Warren Buffett, for example, like some of these people have made statements that like there's nothing backing crypto, and like that's just fundamentally not true. So like using the DCF analysis just sort of cuts through a lot of the noise. Like, okay, this thing is producing this amount of cash flows. We can discount those, get to a present value, apply it to the circulating tokens, and like there's a way to like get a base level of like what this thing should be worth just based on the like revenues it generates. That's kind of like where I would stop there. That's like one piece of it. There's many nuances to this because those revenues are earned in the native asset itself. So, which has a recursive nature to it. It's tied to the value of obviously Ethereum, the network. So like there's nuances to this. But that's kind of like just the simple framing, really kind of basic analysis. And then we can get into like total addressable market analysis, GDP, things like that as well.
Yeah, we'll do those next. Just quickly on the cash flows. That is probably the most easily approachable one from a traditional investor's perspective. And we saw it used pretty well in a great piece by VanEck recently, which, if I'm not mistaken, was the first proper crypto asset analysis from a major institution. And it was a cash flow projection based model. I have to also mention that the model they put together utilized token terminals data, which was great to see. But essentially, they put together a cash flow projection based on several variables and derived a 2030 price estimate for ETH. I'm assuming you've probably read that a few times. What were your thoughts on kind of the framework that they applied to Ethereum?
I loved it. And it's a lot of the stuff, it was interesting to see because it's a lot of the stuff that I've been thinking through myself. And I think that was the first like really deep analysis I've seen a major institution put out publicly like that. I think part of what they did as well is like this addressable market element to this, where this is really hard to forecast what is the addressable market for something like Ethereum. But I think it's another way to get to like a pretty interesting traditional framework that traditional investors would use. And VanEck did a good job with this, but they basically took all of the potential markets that Ethereum could disrupt, finance and payments being like probably the biggest one. But, a layer one blockchain like Ethereum could also have impacts on like gaming markets, on social media, on cloud compute and data storage and entertainment and music and art and all of these NFTs. So they basically took the current, they projected out what is the, total revenues of all of those various markets, what percentage of that should potentially move on chain, by 2030, and then what would Ethereum's market capture be of that percent that comes on chain. And so they sort of forecasted that out to get like an addressable market, and that like played into how they did some of that cash flow analysis as well. So I think that was interesting. That's a useful exercise as well, just to like wrap your head around, okay, this is the potential addressable market. Models, as I like to say, like all models are broken, some are useful. Like it's probably not super accurate, but it gives you a framing of like how big something like Ethereum could get.
For sure. Yeah, I totally agree. The total addressable market is pretty hard to quantify, and it actually really forces you to think about the true scale of the markets that crypto is trying to disrupt. I've had some pretty good discussions with many core contributors to different layer one blockchains about how they view the size of the market. And the answer is usually that we don't know yet, which is true, because the infrastructure that we're building here can, in best case scenario, basically replace the rails for all economic activity in the world. So you could say that the potential is pretty massive, but just quantifying it right now at these early stages is really tough.
Exactly. And yeah, and it's like how do you forecast that out? It's really hard. And I think like going back, I've seen some interesting like analysis on like Uber was like doing like total addressable market analysis on like the taxi industry back when they were coming up. And investors were trying to project like what the potential market was there. They were very early and like they were worth like $1 billion. And people were like, how is this possible? You can't be worth, like the whole industry is only worth 2 billion. Like how are you worth? But it turns out they blew that all away, because when you like compress costs and you like create network effects, you can really just blow away like total addressable market, even forecasts, because the new market you're creating is going to be fundamentally different than the one that currently exists. So yeah, it's useful, but also good to understand like these are new concepts. And yes, Ethereum could be the entire settlement for many different types of industries. It's hard to project it out. Our forecasts today, I always say, are probably lower than it actually potentially could be. So
one analogy that I really like is comparing blockchain networks to economies, where a blockchain network like Ethereum acts as a settlement layer for all economic activity happening on top of it. So it sets the rules for the businesses and their users. And then of this economic activity, they take a tax, which is the transaction fee. And that's how the network captures value, which is then used to incentivize validators who keep the network and its infrastructure up and running. And you can actually think of like the US economy, for example, simplifying things quite a bit, where the US economy kind of maintains the infrastructure for all economic activity, sets all the rules for the businesses operating within that economy and how all the people should act, and then takes a cut of all value generated as taxes, which they then use to kind of maintain that infrastructure. So when we simplify things a lot, blockchain network and a country are actually very similar. And when we think of like a country or an economy, GDP is a pretty big indicator of how well they're doing. And you mentioned earlier the GDP analysis. I'd be keen on hearing how you see that could be used to value crypto networks, as they actually can be thought of as something very similar to a nation state's economy.
Yep. This is just like another kind of piece of the puzzle, I would say. So I would do this analysis along with the DCF, along with the total addressable market analysis. But yeah, so I think this is a helpful analogy. So this idea that layer one blockchains are their own country, for example, and they have a native currency, and then they have an economy built on top of it. So like for Ethereum and token terminals, great resource for this stuff, but you can essentially go by sector of all the different sectors of businesses that are being built on top of Ethereum and look at what the revenues are for those various sectors, and get an idea of like, okay, this is sort of like the GDP of Ethereum. And then you can compare that relative, the way you would value the dollar versus like the euro is like a relative comparison based on the demand for the currency and also like the GDP and like the infrastructure of those jurisdictions. Similar concept, I think, applies to like the layer ones. Like you said, Ethereum is providing the infrastructure. A country is providing a system of property rights and laws, and they collect taxes for doing so. Ethereum is providing a settlement layer, a secure settlement and computing layer that all of these businesses are paying to use. So I think that is a very useful way to look at this as well, and also to primarily to do relative comparisons to other layer one networks.
For sure. Now, maybe finally on the valuation methodologies, like a few more specific, directly metric driven ways to think about valuation. And I know a few we spoke about when prepping for the session was like metrics like L2 take rate, app protocol layer take rate, and then potentially like validator yield. How do you think of these metrics in the big picture of how they could be used to value?
Yeah, this is a great question as well. So we've talked a lot about just kind of more like the high level, like ways an investor can think about something like Ethereum. And now we're getting more into like, where does value accrue within the tech stack? So if you think of like the layer one as the final settlement, you have layer two blockchains now that are picking up adoption, and those are providing execution services, which reduces the costs, increases the throughput of kind of the L1. And then you have the businesses that are leveraging those L2s. So the L2 provides a service to the users of the applications on top. And the exercise here is to figure out when a user goes through, uses an application that's leveraging an L2, and they do a transaction, maybe they're on Uniswap and they swap a token, how much of that user fee gets paid to the liquidity provider, that's Uniswap's take rate, and then how much does the L2 take, and then how much of that gets paid out to the validators of Ethereum on the L1. And the early analysis of this is that the L2s, like if you look at Optimism and Arbitrum, their margins are about 30% right now. This was something that VanEck actually had looked at as well. And they were projecting that those margins are likely to compress down to like 10% as more L2s come in and the market gets more competitive. And then you also have like the apps on top. And most of the margins that they had calculated were somewhere in like the 80% range for the app layer. So this is like a useful exercise to go through. So if all of this stuff is built on top of Ethereum, everything has to flow down to Ethereum at some point. What is Ethereum's like margin? What are the unit economics for every user that comes through Ethereum? And this is kind of the final, much deeper analysis to get to like, okay, if we have this addressable market, it's all going to Ethereum. Now we have to segment out how much do L2s capture of that, how much do the apps capture, how much does Ethereum capture?
Yeah. It's complex. Definitely at a stage where this is the bleeding edge for investors exploring valuation frameworks in crypto. It's hard for me to imagine players like BlackRock applying for Bitcoin spot ETFs without them having internally kind of discussed how we should be valuing these things, or Fidelity and Citadel without them having frameworks with which to pitch to their larger clients on how they should be looking at this stuff. So it's definitely going on. Things are developing quickly. I don't know if you have any general thoughts on with these latest developments, and how do you see valuation frameworks developing from now on?
It's exciting to see. I think the BlackRock ETF is like super important. I've been having some conversations with some larger, institutional asset managers. And I think one of the interesting things that I'm seeing in this like crypto winter that we didn't see in the past is like a lot of institutions like coming to the realization that most of this is going to play out on public blockchains. So moving, like really getting more strategic about public blockchains and moving away from private blockchains. So that's one piece of it. The BlackRock ETF, I think is huge. BlackRock, I saw something that they are like 571 and one when they have like applied for an ETF. So there's only been one ETF that they didn't actually get approved for out of 576 of them. So they know what they're doing. And, I think this is going to be really interesting. It is going to impact like market structure as well. So like if traditional investors can easily access a BlackRock ETF for Bitcoin, like what does that mean for Coinbase and like some of these other institutions out there? I think that's interesting. We'll see how that starts to shake out. But this to me is just another sign of like the stigma of crypto is eventually going to wear off once you see more of this like integration with traditional finance, fundamental analysis, people coming to consensus like we talked about. We have this consensus for how to value and analyze traditional assets. This is going to come. This is my thesis. I believe it's Token Terminal's thesis. This is going to come to crypto. These large traditional players, the ones that are moving now, are clearly seeing that, and they have the same thesis, and it's smart for them to be moving in this direction, because this is ultimately the direction that I believe all of finance is going. So we're starting with crypto and crypto native assets, but the infrastructure of these public blockchains is so powerful that eventually I think you're going to see tokenized securities and eventually like just tokenized stocks and bonds and things like that all moving on chain. So it's exciting to see them coming along. Obviously, we have some regulatory issues that we're looking to like get squared away in the U.S. But some of this is a positive development. Seeing that BlackRock is getting in now, I think they're super smart. I think they see the timing as well, because the Bitcoin halving is coming less than a year away. I think the timing of this is really interesting. Also with what's happening in like the macroeconomic setup as well. I think that looks pretty good for crypto over the next year or two. So exciting to see all this. We needed it. The industry needed it after the last year or so.
It did. Finally feeling some signs of hope. But that is great. On-chain is the future. That's what we're building for. This was a really insightful session. Thank you so much, Michael, for joining me here. I know this is the first time we've kind of spoke about these topics in this kind of forum on here, but I feel like this is a concept that I would definitely like to keep as a reoccurring one. And maybe now that we've covered the high-level basics, it would be great to have you on every now and then to kind of dive deeper into some of these, or then maybe into specific projects and just do like kind of deep dives on how they could be valued or some industry trends. Really appreciate your insights.
Would love to come back anytime. Yeah, enjoyed doing it. And thanks for asking some awesome questions.
Now, for these listeners, anyone wants to follow your stuff, where's the best way to do so?
Best way, I'm primarily on LinkedIn. So you can find me on LinkedIn. I share a lot of analysis there. And then I've got a newsletter called the DeFi Report. So if you just Google the DeFi Report, Michael Nadeau should show up there. We do a lot of deep business model analysis, data driven, use a lot of token terminals data in that analysis as well.